So it's the halftime report. Some of you guys were on for the state of the markets back in February. That's where the year just started. So now we're going to be doing the halftime report. See how it's going. Okay, standard disclosures here. I am Open Vistas, but we are now Osaic Wealth. Last time I was part of Royal Alliance and Advisor Group, they renamed themselves Osaic Wealth. So I'm now part of Osaic Wealth. Questions? Jump in whenever you want with questions. Okay.
I thought I recently got mail from Royal Alliance.
Yeah, I think the last day is August 8th or something that they're going to change the name.
Aha.
By August 8th, everything has to be fixed. So some stuff I know it's still coming out that way. Okay. I think everybody knows me, but I'm Greg, behavioral financial advisor. My personal life's work is to empower people around their finances, help them build wealth, create security, and enable their dreams. You can pop over to my website, look at a lot of stuff out there, good information for free. And if you want to talk to me, you can go to consultationwithgreg.com and set up a meeting with me or do it off my website. Okay, so some of the key areas of financial planning here are, big picture stuff is financial success has more to do with your behavior than investments. So you popping in and out of the markets, does it meet your risk tolerance, all those things. So it really is your behavior more than the actual investments themselves. The only certainty with the markets is uncertainty, right? Markets fly up and down all the time. And as the next thing says, you can't predict the market, but I can't predict the market. I can help you prepare for it because it's going to change, right? Make sure that you are aligned to your values. Some of you have worked with me doing the value cards. Some of them it's not yet, but some of you guys have worked with me doing the value cards. A little exercise to find your values. And then we have the smart money philosophy, which we'll go over right now. Okay, so smart money philosophy is making sure you have smart money where you need it, when you need it. I don't like this, but you're starting with death. So if you die, do you have life insurance and have you done estate planning? If you need it. Not everybody needs it, but say you're healthy, you're living, but then you end up getting sick or injured or disabled. That's where health insurance comes in, Medicare, disability insurance, long-term care insurance, and all those things, right? That's all fits in there. If you have good health, then you end up with poor markets and good markets. So what do you do with those? That's investment planning, retirement planning, estate planning, tax planning, and family and education planning. That all fits underneath there. And like I said, I do values cards and come up with aligning your ideal self with your real self, right? So your ideal self is over here. It was over here. It's your principles, your values, your beliefs. And then over here is your real self, is your behaviors, your thoughts, your feelings, your actions. In the middle are the goals. You have your values, your goals, and your behavior. And we make sure they're all aligned. Okay, so got a lot of stuff there. So just first poll here, let me grab the polls if I can, hold on, is, okay. Can you guys see the poll? Hello?
Yes.
Okay.
Yes.
You can see the poll? Good. Okay. So
Now I do.
okay, I think it takes a second to go up. Okay, so what area this you can pick multiple, not just one. You can pick multiple here. Is what areas of financial planning are most important for you at this time in your life? Like investment planning is how should I invest based upon your risk and everything else. Your budget cash flowing, like how do I spend my money? Is it aligned to my values? How do I pay off my credit cards, student debt, and all that kind of stuff? Retirement planning is when can I retire? Will I have enough money? It's not really your assets here. It's kind of guaranteed income. So will your guaranteed income cover your needs? Family education planning, like 529, special needs family members. Insurance, like health, Medicare, disability, long-term care. Estate planning is leaving money to your family. And then tax planning is how can I efficiently invest and leave money. So you can pick one, you can pick multiple. Okay, so end the poll. Okay, so it looks like only one person answered. Wait, hold on, share results. Can you guys see that?
How do we answer it?
Oh. You were supposed to be able to answer.
You should be able to click those little boxes that are like to the left of it.
Oh, okay.
Let me see, let me get back in. Relaunch poll. Okay, hold on. Okay, sorry. Whoever answered before, can you re-answer? And everybody else, so there's, yeah, I'm not seeing what you're seeing, so I can't really see it. So there's like a little checkbox next to it.
It's a circle. Yeah, it's a circle to the left of, like, there are 3 different questions with like 4 different possibilities for each one. And it's a circle to the left of the possibilities. You just click the circle.
And right now, we only need to answer the first one.
Yeah, but I hit submit and nothing happens.
Greg, I think you have to answer all of them for the submit button to light up. That's why.
Oh,
You
really?
have to answer all 3. Yeah.
Oh,
Yeah.
sorry, guys. I didn't. That's weird. We're jumping ahead then.
That's what happened for me anyway.
That's a new. Okay, so I guess I did that wrong, guys. I'll have to fix that for next time. I guess it's 3 questions for 1 poll. They should have done different polls. Sorry about that. I did that wrong. Okay, so I got to answer all 3. Okay, so question number 1 is, please answer that. And you have to go to question number 2 is, how comfortable are you investing in the market right now? So please answer that. Not at all. Keeping your current investments, are cautiously interested in investing, enthusiastic. And then number 3, sorry, we're really jumping ahead, is how do you think the market will perform in 2023? Go down 10%, stay even, go up 15%. By the way, it's already up more than 15%.
Right.
Be up more than 25%. So far I only got 1 person answering. I guess that's you, Kenny.
I can't get to number 3. It won't scroll.
Oh, that's weird.
Maybe use your cursor instead of the mouse.
I'm doing that.
Is that not working either? Yeah, sorry, I guess they needed to be separate polls. I thought.
In mine,
Oh, I got it now. I finally got to it.
I can't see who. I only got 2 people did it. So Franco, I don't think yours came up either because you have to answer all 3 questions, I guess.
I did.
And you hit submit?
I did the whole thing. Yeah.
Hmm.
I answered all 3 questions and closed.
Here we go. Okay, I got it now. Sorry.
Okay.
I guess it was just taking a minute for me to get it. Okay, so I'll end the poll. Okay, share results. Okay, can you guys see anything? I'm not.
Yes. Yes.
Okay, I guess
Yes.
you may be seeing what I'm saying. Okay, so looks like 2 of 3 people liked investment planning, 2 of 3 like budget and cash flow planning. Let's jump to the next poll. Just even though we remember what it was. Okay, keeping your current investments 2 out of 3 and cautiously interested in 1 out of 3. And then what do you think the market will be? 1 said even and 2 said 15%. It's a little more than that right now, but it's right around there. So, okay, so let me stop sharing that. Okay. Okay, so over to the next one. Sorry about that. Get that fixed for next time. Okay, the agenda is look at the first half, look at the second half outlook. Where are we now and what's ahead for the second half? Okay, so US markets. So just to show you last year in 2022, this is what happened with the markets. So the Dow Jones ended down 8%, the S&P ended down 19%, Russell 2000 down 21, and the NASDAQ down 33. That's how we ended last year. And also a 60-40 split, so 60% equity, 40% fixed income. That's kind of a standard thing for people that are retired, getting close to retirement. The purple is the bonds, the fixed, the blue is equities. This is from 1977 until last year. And you can see actually one thing is last year was the first year ever that they were both down. Right? Sometimes they offset each other. Every other year was down, the other one was up. And you can see fixed doesn't normally go down, but it usually offsets equities when they go down. Last year it didn't. So in fact, it was as bad as 2008 because fixed went down. In 2008, fixed helped the equities to only lose 20, but because they came together, last year was tied for the worst. We already answered this question. I forget, it was, I think 2 is keep current, 1 cautiously optimistic. Beginning of the year when we did this, 8% said they're not comfortable at all investing. 54% said keep it the way it is now. 30% said they're cautiously interested, and 8% said they're enthusiastic. So that 8%, if they did it, they did well. Even if they cautiously interested. Anybody who invested, depending on what you invested in and how you did it, but in general, the markets have gone up. So since we took the last poll. So what happened this year? Okay, so in January, the CPI, the Consumer Price Index, went down a little bit. So the consumer prices have been flying up, right? Everything's getting more expensive all the time. So it finally went down a little, tiny bit, but at least it went down. So, you know, the market had been going up, so the market went down a little, then went up. It's all over the map here. During the whole year, like inflation was hitting us, right? So it started, I guess, well, on May 10th, the banking, those 2 banks crashed. So, you know, the market didn't like that. And it started creeping up ever since then because inflation kind of started to slow down. People hoping the Fed would stop raising interest rates. The Fed keeps raising interest rates to slow inflation. So money gets tighter, hurts the stock markets. So, but once that all happened, people felt the Fed could stop raising the rates. They haven't stopped yet, but it looks like it's trailing off. So inflation's coming down, Fed's trailing off. So then there was recession fears. So we had it was. Hello?
Say hello to him for me.
It's so lovely today.
I'm sorry, let me tell Jesse to.
I'm hearing dogs.
Sorry, I'm just gonna mute my.
Okay, so gross domestic product, which is, you know, all the cost of everything that's produced in the country, went up a little bit. So it's going up, went up. So people like that. Inflation started to cool down. There's a whole debt ceiling negotiations. I don't know. To me, it seems like when there's a Republican Congress and a Democratic president, the Republicans start saying, hey, we shouldn't have a high debt ceiling. So it's always a big fight. But once that got cleared out, the market took off. So things have been doing well, right? Since March 10th, things have basically been going up, really because recession fears have kind of subsided. Inflation's going down. The Fed looks like it's going to trail off. So things have been good. We polled everybody back in February. Again, so 0% thought the market was going to go down, 20% thought it was going to break even, 40% thought it was going up 5%, and 40% is going up 10% or more. It's already up more than 10%. Doesn't mean it's going to end there, but as of now, it's up more than 10%. We already asked this question. I forget the answers. I got it back there, but I think somebody said 0 and somebody said 15. Just to show you what the big guys thought. Now, this is beginning December 31st, so at the end of last year, they were thinking it was going to be 3,800. And on Thursday, it closed at 4,537, so greater than anybody thought it was going to. So the market's doing much better now than all the big guys thought. I think Morgan Stanley, all these guys, Goldman Sachs, it's doing much better now than they thought it would. It doesn't mean it's going to end there, but the market's doing better than I thought it would. Okay. So I think I showed this last time to everybody. So back in January of 2022, everything looked good. Right? A lot of green here, everything's gung-ho. Political, geopolitical risk, and equity market valuation were a little skeptical, but everything was gung-ho. Let's do it. And that was January 22 of 2022. As we all know, 2022 was a really bad year. So January 2023, 1 year later, everything's in bad shape. Right? Monetary policy, I got a lot of red here. Yield curve, housing mortgages, interest rates are flying up, leading indices are crashing. The whole international economic outlook is bad. Geopolitical risk is bad, right? The war in Ukraine, China and Taiwan. Even the ones that aren't red, everything looks pretty bad, right? So it's 1 year later, went from really good to really bad. So where is it now? Not much better, right? Even though the market feels like it's getting better, things are going better, the economic and financial indicators are still not there. So a little cautious out there. We had trouble with the banks, right? So with the banks, when they crashed, they were regional banks. They weren't the big banks, but they're regional banks. But regional banks give out a lot of money. So when regional banks crashed, everybody got scared. They're pulling back the money supply. They're not giving out as much money. That makes everything contract. So people got really worried, like, oh no, it's going to crash everywhere. It didn't. Hopefully it won't. But better now. So that's how things are going with the market right now. I mean, the market's doing well, but the indicators are still not here. There's another one showing the market. So the yellow line is S&P 500, and the gray line is the earnings per share. So basically, how much money is a company going to make? And you can see they kind of go together, right? They're going together. Everything crashed. But look what happened here. The expected earnings were down here, but everybody jumped on the S&P 500. That's going to go, the S&P 500 jumps a lot faster than the expected earnings per share for companies. And the stock value is based upon earnings per share of the companies. So the S&P 500 jumped quicker than earnings per share jumped. It was going up, but not like, so now it kind of, 2022, they kind of came back together. So, it got ahead of itself basically in 20 and 21. Because remember, everything was gung-ho those years. You can see that was probably not the best thing. Okay, so inflation. We all heard inflation, got really high. So the Fed likes to keep inflation around 2%. And they kept it around 2% for a long time. But they're showing you here, the Fed, right? So the Fed is kind of has three main functions. Effective payment system. So they actually do a lot of behind the scenes, like money, bank-to-bank money transfers, all that stuff is kind of done behind the scenes at the Fed. So that's one of the main things. And they have to regulate the banking operations, make sure banks don't go out of business, right? That's one of the big things too. They supervise banks, they regulate banks, they make sure the banking system is solid. But the third really important thing for us is monetary policy. So they're responsible for monetary policy. So if inflation, right, that's on them. All that stuff is on them. So with monetary policy, it's what they're responsible for is maximum employment, stable prices, and moderate long-term interest rates. Okay, so employment's pretty well, right? The employment has held up pretty well, which we'll see in a minute, which is really good for the economy. That's really good that that held up. Stable prices is not happening. Inflation's, as you see, was 9.1% back in March, I guess April, whatever it was, in 2022. The inflation really shot up. So to calm inflation, they have to. Hello?
Hello.
Hey, Joe, is that you?
Yeah. Hey, how you doing?
Hey, Joe.
Hey, how's it going, Kim?
Good. So we're talking inflation. So,
Lovely.
well, look at it. I don't know if you can see the screen or
Going
not.
down.
What's
Yep.
that? You can see it?
It's
Okay.
going,
So inflation got really, like I say, inflation, they like to keep inflation at 2%, which is actually below the line here. The Fed likes to keep inflation at 2%. It got up to 9.1. Then it started to come down. This is year over year. So April of 2023 is 4.9% versus April of 2022. So, actually, June, last month, it's down to 3%. So it's been working.
nice. And 3%, isn't that the standard, what people, where they like it to be is about 3%?
They like it at 2%.
Okay,
So that's why they're still raising rates. They're trailing off.
Okay.
But yeah, they like it. 2 is really low, but they had it at 2 for a long time. So, so they still may be raising rates because it's not at 2% yet. So they trailed off a little bit, but it happened. It just happened, right? They just, they're at a FOMC meeting. I'll show you in a minute, like last week, whatever. They raised it again, and they may raise it again. They said. They're not.
yeah, I know. My loan, I'm sorry, I shouldn't be talking. There's a bunch of people on here, right? I'll stop talking.
Yeah, you can talk. I like it to be interactive.
No, it's good. It's good.
Go ahead.
My loans keep getting raised. My business loans keep getting raised.
Exactly.
Percent.
And that's why,
Mm.
that's what happens. That's what actually why the Fed raises interest rates. Because if the economy is too hot, inflation's coming in strong, prices are going up, they want to raise the rates so people stop borrowing. So it takes money out of the system. So it kind of cools everything down, right? So-
Yeah, what about us who've already borrowed?
They're gonna make you pay back or stop borrowing. Yeah, so or don't borrow, or borrow fixed. So
Right.
so they're trying. The big thing was recession too, right? Are we gonna go into recession? So recession is a technical term. Recession is 2 quarters lower of gross domestic product. So the gross domestic product is the cost of goods, like everything that's produced in the country, in billions and billions and billions of dollars, whatever. If that goes lower 2 quarters in a row, that's a recession. But that happened last year, like a few months ago, but it wasn't a recession because they said because the labor market was doing so well, they decided it wasn't a recession, even though technically it was a recession. So
They changed the definition.
exactly. I guess you could say that. Because everybody always thought it was 2 down quarters. It's a simple, very simple answer, 2 down quarters. Okay, so inflation's been going up, so that's why I've been raising the rates. Okay, so so the labor market. The labor market has kind of helped save everything here because it was very resilient. So the yellow line is current job openings, and you can see on here the percentage of firms unable to fill positions right now, right? So so right now it's 45% can't fill the positions that you want to fill. And unemployment, well, obviously spiked, right? So when COVID hit, well, these little like gray areas are recessions, right? This is when recessions hit. So we had one back when COVID hit. So unemployment shot up because everybody got knocked out of work because of COVID, right? Nobody could work, especially in like food industry and all that kind of stuff. But it's come back down. It's below 4%. It really went right back down to below 4%. So
Wow.
yeah, so it's and when people work, they make money. When they make money, they spend money, right? So a big thing of the economy, 2/3 of the economy is consumers spending money. So
Right.
if nobody's working, nobody's spending money, it snowballs, right? Nobody wants to buy anything, nobody wants to make anything, so it just really snowballs. So kind of the unemployment rate kind of saved the economy right now. So I know it was
So
the
this
great,
is, oh, sorry.
but this is like, even with the Great Resignation, right? People were like quiet quitting and the whole bit, all that stuff, right? So, but unemployment's really low.
The
This
great
is like the lowest
resignation.
unemployment.
Go ahead.
Oh, this is the lowest unemployment rate in I guess like almost 40 years, it looks like.
Yeah, it's really low. So, went down.
Sorry, Joe.
It's really going down before COVID hit, right? It was doing really well, and then boom, COVID
Yeah,
came right back
yeah.
down. Because people needed to work. Okay, Joe, you're asking something?
No, go ahead.
Okay, can I ask questions? Okay, so the labor market, thank God, has kept everything going, right? Okay, so consumer sentiment. This is the University of Michigan Consumer Sentiment Index, and that is how people feel. Like, it doesn't really matter what reality sometimes, it's just how people feel, right? How do people feel about the economy? Okay, so you can see after COVID, it's like it went down really bad during COVID, right? People felt really bad, but it kind of worked. It has been working its way back up. Right, oh, actually over here, it went, crashed here during COVID, and then it's working its way back up. Now it's coming down a little bit again because people worried about recession, so they're still not fully back here. It's started to work its way up, but it's kind of still not fully back. So this is kind of not good because, again, if people don't feel good about the economy, they may be less likely to spend money because they want to store the money just in case and save it for a rainy day. So if this number goes up higher, it's a good thing. Down low is not a good thing for the overall economy.
What
Can I
are
ask
the
a
gray
question
bars
about this?
showing?
Oh,
People-
go ahead, go ahead.
Hello?
Someone just asked a question about the gray.
Yeah, what are the gray bars for from that last?
Okay. These are recessions. It's during a recession. We had a really short
Oh,
recession.
that's length of time.
What was that?
The thickness of the bar shows the length of time of the recession.
Yeah, that's time in recession. Like, how many months? So we had a longer recession. Yeah, this is, how many months in the recession. So we had a really fast recession. I'm sure it's one of my charts here. Remember the stock market kind of crashed and then shot up quickly. So we had a really small recession back when COVID hit.
Right.
I think
So
10,
Greg, yeah. So do you think, like, given the fact that like consumer sentiment really doesn't match the reality, it's lower than the reality, do you think it's poised to rebound? And if so, what's that going to mean?
I think once the Fed stops raising rates, and I think right now people are scared because of recession, right? We keep hearing recession. So
I haven't felt that in a while because, I guess it depends on which news network you listen to. But,
true. It comes and goes, it gets a little higher. Then it's like, it's they're looking for the soft landing. And it's actually called Goldilocks. They want a Goldilocks economy. And why it's called Goldilocks? Because it's not too hot, not too cold.
Mhm.
It's porridge, right?
uh,
It's called the Goldilocks economy. It's exactly what you want. You want like low inflation, like 2%, because you want things to go up, right? So you want low inflation, you want a monetary policy that's good for the markets. If it's too hot, they got to slow it down. If it's too slow, they got to heat it up. So it's called Goldilocks, actually. So it's, soft landing into a Goldilocks is what they're looking for. They're actually, it keeps going back and forth. They're thinking now it may be happening. They thought it was going to happen like soft landing, then they got away from it, but now they're back into it. Because the last month or two, this chart's actually like 2 months old. So, in the last 2 months, it's actually looking more like a soft landing could happen. And that's the Fed's job, right? It's really hard for the Fed to do that because all this monetary policy is not like it's a spigot, but it takes a while. It takes months and months for it to actually do something. So you could overdo it, and then you got to backtrack it, but it takes months and months to get back. So it's kind of hard to get a soft landing, but knock on wood, it looks like they're doing it. We just need the consumer sentiment to keep going up because then people spend more money. It sounds
Right.
terrible. We want people to spend money, but spending money is what gets the economy going, right? You don't spend money, the economy stalls. And that's why they put all that money out during COVID. They kept pumping out money to the economy that was the purpose. Because if that didn't happen, it would have crashed, right? The whole economy would have gone down. So they kept pumping money out to keep things going.
So assuming consumer sentiment actually matches reality better, that's going to look good for the market.
Yes, oh, totally. So, but as you saw
That's
from the,
hopeful.
yeah, but you saw the indicators, they look scary right now. So, now we also have the banking system. People got scared about this. So value above 1 indicates financial stress. So yeah, COVID, last recession, COVID,
Wow.
right, was really bad, obviously. It jumped up a little bit here, but then those 2 banks went out in March. It shot it again up, but it's come back down now, right? Because it's like the average here. So so again, banking's a little scary. And that's because people got scared because the Fed was doing so much aggressive monetary policy stuff. It hit those 2 banks hard. Like they did something stupid, basically. They did treasuries that they shouldn't have. They overexposed themselves to treasuries. They weren't expecting the Fed to be so aggressive. So they both did something stupid. But people got worried, is it bigger, right? Is the whole market going to, is the whole banking system going to crash? And as they say on Wall Street, as goes the financial services, goes the market, right? The whole market goes with financial services. If they do well, the market does well. If they do bad, the market does bad. I mean, there's other things too, but that's one of the many things that they say. Also, with the markets, they say, don't fight the Fed. If there was a big thing, don't fight the Fed. If the Fed is going to raise rates, they'll keep thinking they're not going to raise rates until they say they're not going to. You know, if you try to beat the Fed, you get crushed. Don't fight the Fed.
Don't fight the man.
Exactly. You can, but you're going to be a roadkill. So, okay. So where are we now? Okay. So the 3 big things: sticky inflation, recession, and positive earnings surprises, actually. Okay, so inflation. Sticky inflation is the consumer price index, like the things that goes up. The sticky part is things that kind of don't move a lot easily. They're more sticky. So if the sticky inflation goes up higher, that's worse because it's slower to come back. Does that make sense? Where other things,
Because it's sticky.
it's because it's sticky, right? So it's hard to get it up there. Once it's up there, and it's hard to get it back down again. And kind of that's what the Fed's worry about. Even if it gets down to 2%, they're worried because the sticky stuff is a little higher than they want it to be. So, you know, the inflation is 3%, but the sticky inflation is like 4 or 5%. So even though it looks like inflation's down, they're worried about the stickiness, the sticky ones coming down a little bit later, which kind of makes sense. Okay, so recession. Are we going to get a recession or not? Their feeling is even if we do get a recession, it's going to be a very mild one, but people don't like that word, right? Right now there's concern because manufacturing is a little weak. The labor market was doing great, but you can see it's even though it's really good, it's kind of slowing a little bit. And then China is not coming back as much as they wanted it to, and that's China makes everything, right? So they stop. It's so there's still, and the whole world can go into recession too, right? So like inflation, everybody get hit by inflation. Well, recession, all that stuff. It's not just the U.S. anymore; it's worldwide, right? So if China gets hit by it, it may roll over to us. So, what you're thinking, and well, the positive earnings surprises. So, earnings are coming in a little better than they expected. They're still down, as we'll show you, but they're still doing a little better than they expected. So that's a good sign, right? So something's good there. So it's, earnings are up. That's why the market's going up, stock market's going up. Actually, I should have looked this before I got here. Before the market really took off the last 2 months, 3 months, there was only 7 stocks that were moving the market. I think it's expanded a little bit more than that, but basically those 7 stocks, right? Apple and Amazon and Google, Tesla, those 7 stocks were it. If they weren't making money, the whole market was going to be down. So I think we have more breadth now. So that was scary too. You don't want to rest everything upon 7 companies doing it. because if they don't, if one drops out, the whole market's going to get hit hard. But I think it's a little more breadth in it now. I probably should look at that beforehand. Sorry, I should know that. Okay, so what's going to happen in the second half? Okay, so here's a little chart. So this is the gross domestic product, right? They said that everything that's development built in this country is the gross domestic product. So the white is with their previous estimates, and the yellow is the current estimate. So we're basically saying back, they thought it was going to be between the GDP was going to be between 0 and 1.4. Remember, 2 down quarters of your GDP is a recession. Okay, so for the year, they thought it was going to be between 0 and 1.4 originally, but the biggest one was right 1.5 to 2.4. So the previous quarter, they were saying they thought the GDP was going to be between 1.5 and 2.4. That was their.
Hey, Greg,
Yes. Oh,
Greg, this says 2024.
yes, this is for 2024. Yeah, this is what they're estimating for 2024.
Oh, so these are estimates. These aren't what happened. These are what they're estimating.
Right, these are thank you for pointing that out, Joe. Yes, these are all estimates. So I'm sorry, I'm showing this one screen. This is the screen I need to be on. So their estimate in the previous quarter was that their GDP growth for 2024 is going to be between 1.5 and 2.4%, right? That's the biggest white bar here. And, you know, between 0 and 1.4, that was 36%, whatever, right? 36%. This is like 31% or 32%, right? That was the estimate. But in their latest one in May, they kind of lowered, it was 1.5 to 2.4, but now they're thinking it's more going to be 0 to 1.4. So they kind of, their estimates are lower now for the GDP. Their estimates now for the GDP are lower for 2024. That makes sense? I know it's a little confusing. So they've
Yeah.
lowered their
Why is it
estimate
going so low? Why is it going so low in the end of
because it's yes, they're worried about the recession, worried about everything else, right? So the gross domestic product is pretty low, and that's I said, two down quarters of GDP means recession. So we're
Right.
trying to not get that, right? So, so they're worried about companies being able to produce and all those things. So unemployment and inflation is still kind of here. So yeah, so they kind of lowered it. And again, this is for next year, so next quarter they could raise it again, right? This is just their estimates.
That's kind of weird how why they think that's going to happen. I mean, is there any you're saying because they don't think the America's going to be able to produce what it needs?
Right, because if people are buying, if there's a recession, there's a lot of factors in there, right? And they're not really
So
sure.
you're thinking they're thinking there's going to be a recession. That's why it's going to go down because there's going to be less growth because people are going to be buying less because there's going to be a recession. That's why.
Well, one causes the other. Right? People buying less is going to lower the GDP, right? So, right,
Right,
exactly. They're
exactly.
going to be scared. They're going to like the consumer sentiment index we looked at before is going to be lower. So they're going to produce
So
less.
it looks like they're thinking there's going to be recession the way they have it planned out here.
Well, no, because recession would be this one here, right? It's negative. 0 to 1.4 you're not in recession yet. Down here, you're in recession because it's negatives.
Okay.
I know. So,
right.
yeah, so it did go up, right? So the possibility for recession in 2024 went up. It's only 15%, but it did go up a smidge. That make sense? And then
Yeah, I don't
unemployment,
like the graph.
it's confusing. And then we do it again and again. So, so for the unemployment, so they thought unemployment is going to be between 4 and 5, basically, right? That's what they thought, but now it went down to 40%, and they raised up between 5 and 5.9. So they think unemployment's going to also go up a little bit, right? They lowered it between 4 and 5 and raised it between 5 and 6. So they think unemployment's also going to go up next year. If, you know. But they also raised between 3 and 3.9. So they also raised up the, so, you know, their still feeling is between 4 and 4.9, right? These are the highest. right? And then the next highest is between 3 and 3.9.
Who puts these out, Greg? Who makes
Uh,
these charts?
This comes from it's the Federal Reserve, but the Federal Reserve is getting it from a bunch of, they survey a bunch of people. They survey a bunch of
Okay.
clients.
So
So
this is government. This is what the government is expecting. Okay.
well,
Thank
the Fed isn't really the government; it's a quasi-government. It's like the post office, but it's not the government, but it's a government agency-ish type thing. So, okay, and then personal consumption, right? So the inflation for personal consumption. So again, these are the big ones, right? So they thought it was going to be inflation would be between 2 and 2.4. Even they had it even, right? Between 2 and 2.4 and between 2.5 and 2.9 were even. Now they lowered the 2 to 2.4 and raised the 2.5. So they're thinking right now it's going to be between 2.5 and 2.9%. Remember, the Fed wants it at 2%. So there's still some economic issues out there. Okay, so we're talking before what's happening, right? So the S&P 500 has basically been, well, it's been moving right between these, but it's kind of, right? So the stock market's kind of been, and now it's going up even higher, right? It's gone up here. But the earnings per share, so bottom up earnings per share, that's looking at every company in the S&P 500. How is it going to do? There's the top down is like, how is the whole economy going to go? Bottom up means, this company's going to do this company can do that, right? So the earnings per share for companies, they think is going down. Right.
That's not good.
Right, exactly. Okay, good answer. That's not good. At least for the stock market, that's not good, right? Because if a company's earnings per share goes down, in theory, their market price should go down, right?
Mhm.
So because their earnings, right? Their earnings, they're not making the earnings that they made. So their earnings are going down, but the market's not showing that, right? The market's still up here. In fact, the market's going up. But the S&P 500 it's supposed to know everything. It doesn't know anything, but it's supposed to be today and like 6 to 9 months out. It's supposed to look at the future. It's hard to beat the S&P 500 because everything's factored into everything with the S&P 500. So the question is, the market feels earnings are going up because the market's going up. But the projections are for earnings to go down. So who's right and who's wrong? So that's just a caveat out there. Right? Nobody knows for now, but the S&P 500 tries to factor in future. It's not for the S&P 500. The market really is not based on reality. It's based on what people think is reality, right? So what's the term? You
Extrapolate.
you invest in, I wish I had the right term. You invest in the guess and you get out for the news, right? You're buying with thinking where it's going to go, but when the news comes out, then you get out because it's reality. You kind of care. You're buying for the future as opposed to reality. It's a fancier, I just can't think of it right off the top of my head.
It's called guesstimate.
It's a guesstimate, yes, but it's an actual term. I wish I could remember it. I guess buy the hype, sell the news. Maybe that's what it is. Buy the hype. Buy the hype, sell the news, basically.
Yeah, that makes sense.
Okay. So here are the projected earnings growth for 2024. As you notice, everyone went down. Everyone? No, actually consumer staples didn't go down. And I guess energy didn't go down because it's less of a loser. So it went up. So consumer discretionary, this is, they thought the 2024 earnings growth was going to be 22.7% back on March 31st, but now they think it's going to be 20%. Consumer services, info, tech, industrials, the whole S&P 500, right? This is everything. That's kind of what they think is going to happen with S&P 500. Earnings growth was going to be 12.1. Now I think it's 11.6. So 2024, they're a little worried about, right? This is what happened in March of 2022, and this is March of 2023. Okay, so everything, all the earnings have gone down except for consumer staples and energy, because energy is less worse. Okay, well, here's the sticky and flexible API, right? So the sticky is the one that went up high, so, but it's come down, right? Okay, so we talked about that already. I'm running out of time here. So the FOMC meeting is when the Fed comes out and says we're doing this with the rates, and the market flies. When I was a day trader, I used to watch the stuff at 2:30. Zoom, the market would like fly all over the place. And then half hour later they would talk, and it would fly again. So the July 25th, 26th happened. It was last week. They raised it by a quarter point, and they said they may raise it again. So then we have to wait till September, October, and December and see where it goes.
I wish they'd cut it out.
It's definitely, it's not, it may not be exact top, but it's definitely, you're on the roller coaster. You may not raise your hands yet, but you're getting there.
Right.
Then we go, woo. Okay, so what happens then? Okay, so bond yields and bond prices, they're opposite. I don't know if you guys do bonds or not, but bonds, so basically think about this. If you have a bond that pays you 5%, when the yield goes up to 10%, who wants to buy your bond? That if your bond gives 5%, you want to sell to somebody, and bonds now give 10%, you're gonna say, I don't want your stupid bond, right? I can get 10%. Why do I want your bond? So you have to drop your price to give to somebody to make it worth their while. Get your bond. Bless you. So they go up. So the rates have been going up, yields have been going up, right? So the prices have been going down. But guess what? When yields start going down, what happens to the bond price? They go up, right? So the Fed has been raising everything, so bond prices have been going down. It's at the top of the roller coaster. When it comes back down, bond prices will go back up. And just to show you that, this is over a span. This came from Lord Abbott, right? Lord Abbott. What happens? So 3-month treasuries, short-term bonds, intermediate core bonds, and intermediate core plus. These are different types of bonds. So for the last 7 previous rate cycles, what happened? When the Fed, when they paused their raising, right? They stopped raising, what happened? This is how much the annual returns were for bonds, right? 6 months in, this is what they were doing. A year in, this is what they were doing. 3 years in and 5 years in. Right now, they've been doing negative. So remember before I said that 60-40 split, 60% equity, 40% fixed. So this could be what happens with, what you could make on fixed income bond stuff once the rates pause and start going down. Okay, we're running out of time here, but basically, so just showing you bull and bear market trends. So in here, so 2.6 years, it went up 7 back in 1960s, right? It went up this much and went down. So these are the bull bear market trends. This 11 years, it went up 400% between 2010 and 2020. It went up 400% in 11 years. Right, then we crashed. Those few months we crashed of COVID. Then we went up 114% in 2 years. And now we're going down again. So we don't know this one yet because it's, we actually just finished the bear market. So this actually, we have to update this. The bear market just kind of ended officially. So we're back in, well, I'm not sure we're back in a bull yet, but the bear is done. And this just shows you quickly. Okay. Since 1937 to 2021, so it's a little bit dated. The average return for the stock market was 10.7%. Shows you there's 20 down years, average 12.2%. 65 positive years, average 19.7%. But it shows you here, like 21 years, it was up over 24%. 17 years, it was between 18 and 24%. They're showing you, how well it does in the up years and what it does in the down years. So the important thing for this is this chart over here. is don't time the market. Okay, so if you put $10,000 in January 1st, 2002, on December 31st, 2021, if you didn't touch your money, your 10,000 would be 61,000. If you tried to time it and you missed 10 days, you missed the top 10 days, your 61 went down to 28. You missed the top 20, went down to 16, top 30 went down to 2. Basically, at 30 days, you didn't get anywhere. If you missed the top 30 days in 20 years, you
Well,
went. If you missed the top 50, you lost half your money. If you
Well,
missed the
you'd have to be pretty skilled to miss the top 30 days.
well, what happens is a lot of the times they come in a chunk, right? The market flies. So you miss them because it's very easy to get out of the market. It's very hard to get back in because like, oh, I'm pulling out because it's crashing. But when do I get back in? Oh no, it's going to crash more. Yeah. It's hard to when you pull it out, it's hard to get back in. So, but that's just showing you, how bad it could be if you pull out. So this is something I learned during my behavioral financial advisor thing is investments work, investors don't. Right? There is, I think the Magellan Fund was like one of the first big funds in its first like 10 years. It averaged like 20% a year. The Fidelity looked at their actual participants. Their actual participants made like -5% because they pulled out when the market crashed. So the investment, if you didn't touch it, made 20% a year. People lost 5% every year because they pulled out. So 8 o'clock. One quick thing here is watch out for the fads. The new fad is AI, artificial intelligence. Anybody doing chat GPT out there besides Kenny? Have you guys used it yet? If you haven't used it, you should use it. It's really cool.
It's really interesting. I swear, it's just amazing.
It's like it's better than it took all the data from the internet from up until 2 years ago. But you can get really bad information because it's based on what the internet says. Right. So it doesn't mean it's right. It just means that's what people write on the internet. So Kenny has seen some bad things pop up.
Yeah. You can ask for statistics on something 2 different times and get 2 really different answers. And then sometimes it'll say, oh, I'm so sorry. What I just told you was totally wrong.
But it's learning. So quickly, so what is AI? I think it's artificial intelligence is machine's ability to perform cognitive functions we usually associate with human minds. Okay, so what does that mean? So there's generative AI. So it's like Kenny was talking about ChatGPT. What else is it? Self-driving cars, robotics, right? You guys all do today. If you talk to Siri or Alexa, that's AI. You do a Google search or Bing search, that's AI. So now I just told you, don't fall for the right. I just told you here, don't fall for the fads. But I'm going to tell you anyway. I can't tell you what to do with stocks and ETFs, but what are the big companies? Like Microsoft is really big in it. Google's really big in it. NVIDIA, they do graphics, but they're really big in this stuff. I'm not saying I'm not giving any advice. These are not recommendations. No recommendations. It all depends on you. But there's a lot of ETFs out there too that do this stuff. So give me a call. We can talk about it. I can't give any advice without knowing your particular situation. Okay. Any questions? Even though, sorry, 2 minutes over. Any questions?
Not me.
No questions? Okay. Well, if you want, book a free consultation with me. Consultationwithgreg.com. Review your goals, needs, and dreams. Understand your overall financial insurance situation. Discover new ways to build your wealth, protect your assets, and begin planning for your most important goals and dreams. Okay. That's all my contact info. And I think you're going to get a brief survey